Yeah, I mean, the thing is I've got like a flat spot on the top of my head, so this isn't even that hard for me. Yeah. How much longer until the world record? Seriously? Okay, no, that's complete nonsense. We're not doing that. Hello, I'm Joel Anderson, and I'm here with Invested. Today, we're going to be talking about how to read a balance sheet. Get it? Balance sheets? Balance sheet? Yeah. Before we do, though, please make sure that you subscribe below, because we wouldn't want you to miss any of the tips, tricks, or techniques that we have on this show. A balance sheet is basically a very sky-level look at most of the things that you need to know about what a company owns and what a company owes. So you're not getting a lot of really detailed information about what that is, but you are getting some of that big picture that allows you to get a little insight into a company's finances. You know, and essentially companies are going to publicly release updates to their balance sheet every 3 months. They're required to do it by law, so it's a great way to sort of get information about companies that you might want to invest in. And so the basic thing you need to understand is there's 3 major categories when you're looking at a balance sheet. All right, the first one is assets, which is pretty self-explanatory. This is just all of the stuff that the company owns. Be that, I don't know, the paper clips on Carol's desk or the fulfillment center in Tulsa, Oklahoma. You know, anything that the company owns counts as one of its assets. And then they break that down into sort of a subcategory of current assets. And current assets are different from total assets because those are just the assets that you expect to convert into cash within the next year. So, you know, that fulfillment center in Tulsa, Oklahoma, probably not going to sell in the next year, so that's not one of your current assets. But all of the money that's currently in accounts payable, that you can count. So the second category is going to be liabilities, okay? And this is a different context for the word liability than, say, Joel, you're a massive liability to my delicate china. In this case, liabilities is basically everything the company owes. In another word, it's just debt. It's all the debt that a company has. And much like assets, liabilities breaks down into total liabilities and current liabilities. Money that you know you're gonna have to pay in the near future, that's in your current liabilities, but say, you know, a bond that you took out to fund some expansion that doesn't come due until, 4 or 5 years from now, very different, And the reason why they break up current assets and current liabilities, total liabilities, because when you're looking at a company, you want to have a sense of both how sort of nimble they're going to be in their ability to deal with any sort of short-term problems that come at them. So having a lot of current assets means, hey, we have, cash on hand, stuff that we can use if something comes up. Whereas even if you have a lot of assets, you might be very cash poor and not be very liquid if almost all of your assets are in the total but not falling into that current category. And that brings us to the last and sort of the most interesting category in the balance sheet, and that is shareholder equity. Okay, and that is just all of the assets minus all of the liabilities. That gives you sort of a clear sense of what the company is worth on paper. You'll also hear it referred to as book value sometimes. And it's important to know about a company, but it's not a perfect way of looking at it. If you run like a software company, you tend to have a very low book value, because you don't own trucks and factories and the sort of stuff that really drives up the old asset column. What you own is more intellectual property and this software and subscription services, all stuff that's not necessarily going to factor into your balance sheet, but is still important to the company. And for that matter, shareholder equity tends to vary in a company's lifespan. Early companies that are expanding rapidly and trying to sort of carve out their own market, those are companies that tend to have balance sheets and shareholder equity numbers that will be nightmarish to some people. That's because they're in the process of laying it all out there. They're spending a lot of money on expanding, they're taking on a lot of debt, and they'll probably be okay in the long term as long as they keep, growing revenue and eventually turning profitable. But in the short term, it's gonna look pretty bad. So push comes to shove, when you're looking at a balance sheet, the important thing to remember is that you're getting a part of the story, and a very important part of the story, but you're definitely not getting the complete picture. There's a lot more details to sort of factor in, and you should drill down from that point. But it definitely starts with the balance sheet. So when you're looking at a company and saying, hey, maybe I should buy this stock or not, take the time to look at that balance sheet so you know how much debt do they have, how much stuff do they own, and how much shareholder equity is there, which is essentially, what you're getting a piece of. That's why they call it shareholder equity. Well, thank you so much. I'm Joel Anderson, and this has been Invested, where you can come for all of your tips, tricks, and techniques for investing. And of course, Don't forget to subscribe down below so you can catch future videos. Leave any comments if you have anything nice to say or even something not nice to say. And if you like the video, click that little thumbs up. Thank you very much.